I'm Rob Kingsbury. I'm here today with Ian Lowes, founder of CompareStructuredProducts.com and the Managing Director of Independent Financial Advisors, Lowes Financial Management. So Ian, let's start with the obvious question. What is a structured product?
Right. Well, first of all, there is no set definition as to what a structured product is. And there's a lot of people get confused and label certain investments as structured products when I wouldn't. As far as I'm concerned, a structured product is an investment where the return is defined by reference to an underlying defined measurement, such as the FTSE 100 index, and delivered at a defined date in the future, the maturity date or a potential early maturity date. They ultimately have defined risks, defined charges, and they're linked to that defined underlying measurement. There's a whole range of different types of structured products, from deposit-based contracts to capital-protected contracts, which aren't quite the same, and then capital-at-risk contracts, which, as the name suggests, puts your capital at risk from either the market movement, whether that be the FTSE, the Halifax House Price Index, the Standard & Poor's Index, or whatever that underlying measurement is. And they also have exposure to a counterparty. So you are taking the risk that if the bank goes bust, you don't get paid.
Okay, so you pretty much know when you invest in them what you're getting into.
Yes, we use them alongside more traditional funds, which you know that you don't know if the market's going to rise, how much that return is going to, that underlying investment is going to achieve. If the market falls, you don't know how much loss you're going to suffer. But we use them alongside that type of investment so that we can identify the potential returns at certain points in the future, and we know the level of risk that we're taking. Obviously, if the market completely falls out of bed, then a capital at risk structured product is going to suffer a loss in the same way that a fund would, but they have levels of protection. So as we've seen over recent years, when the markets drop 30% or 20%, some of them are designed to return the original capital in those events.
Okay, that sounds like an interesting product. Are they new to the UK retail market? Have they been around for a while? What's the pedigree of them?
Okay, they first started appearing in the UK market in the early 90s. At the time, there was only one or two in issuance from the odd insurance company here and there. Some of these were reasonable, some weren't so good. But then the market started to evolve, and we got new providers coming in the late 90s. But by around the year 2000, there was providers bringing contracts to market that we felt were unsuitable for most investors. The sort of contract where if the market fell, you were losing 2% for every 1% that the index fell. They offered a nice big headline rate of income, but ultimately you got that income and some people didn't get any of their capital back. That originally stimulated us to start warning about that particular breed of investment. They ultimately became known as precipice bonds. The market effectively recovered from there because not all of the providers were offering this type of contract. It started to grow, and then the market got a heavy knock again when Lehman Brothers went down. Some of the contracts in the UK were linked to Lehman Brothers. You would think from some commentators that all of the contracts in the UK were linked to Lehman Brothers, but that certainly wasn't the case. It was a small proportion. And of course, when a bank goes bust behind a structured product, you are going to lose your capital. So we had a fairly, well, it's not so much unprecedented, but it's an unlikely event of a bank going bust. In this case, it was Lehman Brothers. And people who didn't understand the risk that they were getting into got a sudden shock and found that they were effectively getting none of their capital back. The market has then evolved from there. The literature is very clear as to the risks that you're taking. And so we now have approximately 15 providers in the UK retail market in terms of the products distributed through independent financial advisors. And we have something like 30 to 60 contracts available at any one time.
So basically we're looking at investments that have got quite a long track record. But like all investments, there are good investments and there are bad investments in the market.
Yeah, I mean, it's very much an evolving market. Because having started in '94 or thereabouts in terms of the retail market, this is not a very long-standing investment compared to the likes of investment trusts and unit trusts. But as we're seeing that market evolve, we're seeing the regulation come alongside it, and you do have some very good contracts out there which are suitable for some people. They're not all suitable for everyone, but there's a whole range of different investments. One thing I should add, there are effectively 3 different distribution channels for structured products. You have the London Stock Exchange contracts, the ones that are listed on the London Stock Exchange, or obviously they're available internationally as well. The UK is evolving a little bit slower than the likes of Europe and America, but we have a significant number on the listed stock exchange. We then have a considerable number that are promoted through banks and building societies and sold to their branch staff. We deal essentially in the independent financial advice market, which are contracts which are bought out specifically for distribution through independent financial advisors.
Okay. In the mutual fund world, we've got the likes of Fidelity, Jupiter, Schroders, and a host of other household names that we can invest in. Who or what institutions are behind structured products? Who creates them? Who issues them?
Right, okay. As I say, it's an evolving market, so we're seeing new providers come to the market, certainly over the last 10 years. But we do have a number of household names like Barclays, Morgan Stanley, Legal & General, Aviva, and the likes. They're all issuing contracts. And there are a number of other providers which offer, in a lot of cases, equally good contracts, the likes of Meteor Asset Management, Walker Cripps. That's the stockbroker with a pedigree of over 100 years and nothing to do with potato snacks. And there are other providers that are bringing them out on a regular basis. Investec are another one which springs to mind.
Okay. So we're talking HSBC, Barclays, Aviva. These are big names, so fairly strong companies then.
Yes, I mean, ultimately, the strength of the company bringing out the contract, let's just suggest it's Aviva, for example, the ultimate risk that you're carrying behind that contract is who the counterparty to the investment is. So you could have a big name like Aviva bringing out a structured product which could, in theory, be backed by a very small building society. Now, Aviva wouldn't do that, and none of the other providers do that. But it's essential that you don't just look at who the provider is and make a judgment based on that. You need to look at who the counterparty to the transaction is.
Okay, great. That gives us sort of an overview of what structured products are. As an investor, what I'm interested in what's the benefit? Why should I invest in a structured product?
Right, okay. I think, as I said earlier, we use them alongside more traditional investment portfolios, the sort of portfolios a lot of people have, which might use unit trusts, open-ended investment companies and the like. Structured products give you that defined element to that portfolio. So we use them with a view to trying to help define the outcome and essentially reduce the risk. And they can be used to completely reshape a portfolio. Now, if we start off at the very low level in terms of the potential returns, if we have a low potential return, we also have a lower potential risk. So they can be used in some cases as an alternative to, say, a fixed term deposit. So you might be wanting to invest in a fixed term deposit for 3, 4, 5 years. The rate on offer might be 4.5%. A structured deposit might sacrifice the interest that you would have otherwise earned in return for some other return, perhaps linked to the FTSE 100 index. So they can be used to reshape a deposit portfolio. We can then move up the risk scale and start introducing different levels of risk, perhaps putting the capital at risk, but only if the market falls by 50% or more over the investment term. So again, you might have your unit trust portfolio, which might suffer a loss if the market falls 40%, and yet you might have a series of structured products maturing at that point, returning the original capital. Now, I'm talking very negative there in terms of falling markets. In rising markets, a lot of structured products will give you a either accelerated participation in the rise of the underlying index or a defined return at a certain point in the future if the market rises by any amount.
So what we're saying here is there are basically two types of structured product, the structured deposits and capital risk products.
Right. There are effectively 3 types of structured products. Again, I'm talking about in the financial advice market. You have, as you say, your structured deposits, which are contracts which, because they're deposits, if they're UK-based, and it states in the literature, they'll have the potential protection of the Financial Services Compensation Scheme in the event that the bank goes bust, subject to the usual limits. Then, as you say, you've got your capital at risk contracts, which put the capital at risk not just from the bank going bust, which let's hope is a very rare event, but also they put the capital at risk if that underlying measurement, whether it's the FTSE 100 index, the S&P 500 or whatever, falls by a certain amount. You then in the middle have contracts which are referred to as capital protected contracts. These don't put your capital at risk if that underlying measurement falls. So if at the end of the term, the FTSE 100 index is 80% down, these contracts are designed to return your capital because they're not going to expose it to any falls in the market. But unlike deposits, if the bank behind a capital protected contract goes bust, then you potentially lose your capital because that bank's gone bust. So because those capital protected contracts are higher risk than the deposit-based contracts, they should, as a result, give you a higher potential return. But in turn, because you're putting your capital at risk from market movements as well as the bank going bust on a structured product, a structured capital at risk product, then that should give you an even higher potential return. And it's all just a function of risk and reward.
Okay. Can we put structured products into sort of tax-efficient wrappers, such as ISAs?
Yep. The structured deposits can be held, a lot of them as cash ISAs, and the capital at risk, the market-exposed contracts, can be held as stocks and shares ISAs.
Okay. You talked about the FSCS, the Financial Services Capital Compensation Scheme. What's the level that people's investments are covered for under that?
Right, it's currently at £85,000 per financial institution per banking licence. So if you have £85,000 in one bank and the bank goes bust, then in theory that should be covered by the Financial Services Compensation Scheme. Obviously, you have to accept the fact that if all the banks go bust, we are in a complete economic meltdown and there is no financial services compensation scheme and no government. But I think in that case, we're going to be paying for it with hyperinflation. So if you really are risk averse, you should perhaps be considering national savings as an absolute protection. Then you can move up the scale, Financial Services Compensation Scheme. There is absolutely nothing that is risk-free. You're still exposed to the likes of inflation risk and the likes. But the Financial Services Compensation Scheme, as I say, £85,000 per banking licence.
Okay. So as an investor, I'm looking at comparestructuredproducts.com. How can the website show me which structured products might be best for my needs as an investor?
Right, okay. First important point, if you have any doubts about the suitability of any investment for you, don't do it yourself. Go and get independent financial advice, preferably from a firm of chartered financial advisors, and don't put it to chance. But that said, I recognise that a lot of people do make their own investment decisions, certainly as far as unit trust portfolios, open-ended investment companies, even spread betting. So there are a lot of investors out there who can do their own research and make their own investment decisions. Some of them may well do better than an independent financial advisor who might, of course, be taking less risk and as a result producing potentially lower returns. Compare Structured Products is designed to give you all of the information that's available for the contracts that are on offer through the independent financial advice market so that you can make an assessment and compare the different types of contracts, the different counterparties, the different potential returns, the risks. There's a whole range of different types of investment that are available through there, and it changes on a regular basis because a contract that might be on offer today, it might not be able to produce that same contract in 6 months' time. So by accessing the information, you can get a hold of all of the product literature for a particular investment. And of course, that's the essential part. You can't make an investment decision based on anything other than a thorough read of the product literature. The site will give you an overview of the various contracts, show you the counterparty, etc., the terms of the contract, and allow you to compare contracts even side by side so that you can see what the market has to offer. And I think a lot of people might be pleasantly surprised when they do have a look to see what's on offer. Structured products, in the main, do what they say on the tin. If they're not going to do what they say on the tin, it will actually say on the tin. So most of them have those defined outcomes, defined risks, defined charges, and all of that information is on the website.
Okay, so a fairly comprehensive way of researching and comparing structured products for the average investor.
Yeah, there are around about 15 providers in that space, and it's usually on offer there's somewhere between 30 and 70 contracts at any one time.
Ian, thank you very much for your time.
Thanks, Rob. It's been a pleasure.